Let us prepare machinery account for this question. Now this question goes as a company purchased a machinery for rupees 8 lakh. Now students, this is the cost of machinery and it was purchased on 1st January 2005. So this is the date of purchase. It is to be depreciated at 10% per annum. 10% here suggests the rate of depreciation on original cost. Now original cost means it is a straight line method. Then additional information goes as accounts are closed on 31st December each year. That is, the financial year that we are following is 1st January to 31st December. So in all, we have purchased a machinery on 1st January 2005 for rupees 8 lakh and this machinery is to be depreciated at 10% per annum on straight line method and the accounts are closed on 31st December each year. So let us see how this would be posted in machinery account. Since we have purchased machinery, the entry would be machinery to bank. That is, machinery is coming in real account, so machinery account debited to bank. So machinery account on the debit side on 1st January 2005, it would be to bank account. Amount would be 8 lakhs. There is no other entry in 2005. So at the end of this year, that is 31st December 2005, it would be by depreciation. Depreciation would be charged and that would be 10% of 8 lakh. 10% of 8 lakh is 80,000. Now students, since it is the last date of the year, we need to find out the closing balance. So the balancing of account would be done. The total on the debit side is 8 lakh. 8 lakh minus 80,000 comes to 7 lakh 20,000. So it would be by balance carried down and the total on both the sides is 8 lakh. Now students, the entries for the year 2005 are complete. Now the balance, that is closing balance on 31st of December 2005 would be brought down in 2006 as the opening balance. So on 1/1, that is 1st January 2006, it would be to balance brought down 7 lakh 20,000. Now again in this case, there is no other entry. There is no information that anything has been purchased or sold in year 2006. That means this machine has been used for the whole year. So depreciation would be charged for the whole year on 31st December 2006 and the entry would be, our posting would be by depreciation account. Now remember, it is 10% on original cost. So original cost is straight line method. So the 10% depreciation would be charged on 8 lakh rupees. That is 80,000. Remember students, do it carefully because it is 10% on original cost. So depreciation would be charged on the original cost of 8 lakh every year. So it is 80,000 this year. Again, since this is the last date, we need to balance out the account. The total on the debit side is 7 lakh 20,000 minus 80,000. It would be by balance carried down. 7 lakh 20 minus 80 is 6 lakh 40,000. The total on both the sides is 7 lakh 20,000. Again, the closing balance in year 2006 would be brought down as opening balance for year 2007. To balance brought down 6 lakh 40,000. Now again at the end of this year, that is 31st December 2007, by depreciation depreciation would be 10% of 8 lakh. Again the same concept, since it is on straight line method, depreciation would be charged on original cost. So 10% of 8 lakh is 80,000. At the end of the year, let us find the closing balance. 6,40,000 minus 80,000 would be 5,60,000. The total is 6,40,000 on both the sides, and do mention it as by balance carried down. Now the question is complete, since we were required to prepare till the end of 2007. You can always bring this closing balance as opening balance in the beginning of the next year and leave the question there. To balance brought down 5,60,000, and that would end your question here. Now it is not necessary to bring it down, but just because of going concern assumption, it actually shows that the business will be continued over next n number of years. So we actually tend to bring it down and just leave it there.